GSFM hosted Nick Griffin, Qiao and James Tsinidis from Munro Partners at a lunch event at the Grand Hyatt in Melbourne on the 27th of February 2025. This event was part of a national series which also took place in Perth, Adelaide, Brisbane and Sydney. It is important to note that the information provided in this audio recording is general financial advice only and doesn't take into account the objectives, financial situation or needs of individuals. Full disclaimers, PDSs and TMDs for the Munro funds can be found on the GSFM website at gsfm.com.au. We hope you enjoy the podcast and find the content valuable. Thank you.
Good afternoon, everyone, and a very warm welcome. My name is Simone Newman, and I work in the distribution team at GSFM Funds Management, and I'm joined here today by all the crew from GSFM, including our CEO, Damien McIntyre, our Head of Distribution, Steve Taylor, and my terrific Melbourne colleagues, Charlie Wood and Zane Layden, and Zane will close us out later today. On behalf of GSFM Funds Management, thank you so much for taking time out of your very busy schedules to join us. We're incredibly excited about what we have in store for you today and extend a very warm welcome to you all. GSFM partners with high calibre, differentiated investment managers to help you build your clients' wealth. And one of those valued partners is Munro Partners. Since their launch in 2016, we've witnessed their remarkable growth. Today, they manage over $6 billion in funds under management across 4 leading strategies. They have more than 30 people, all located in their Melbourne office, and have an impressive double-digit return track record. However, this success simply wouldn't be possible without your trust and support, and for that we are incredibly grateful, so thank you. Today's event is all about discovering the next frontier in global growth. We're living in an incredibly fast-paced and uncertain time, but also one that brings really exciting opportunities. And that's exactly what our 3 outstanding leaders will be exploring today. You'll be hearing from Chief Investment Officer Nick Griffin, who leads the All Caps Funds, Portfolio Manager James Tsinidis, who leads the Climate Fund, and Qiao, Portfolio Manager, who leads the Small to Mid Caps Fund. We'll then follow with around 20 minutes of Q&A before wrapping up and making sure that we have you out of here by 2 p.m. sharp. Before I hand over to Nick, however, we're just going to show you a short video which touches on Munro's rigorous investment process and how they find the few winners within a vast universe of global equities that ultimately delivers excellent returns for your clients. Please enjoy.
Nick, how are you feeling about 2025?
Yeah, we're bullish about 2025.
And then can you tell us a bit about Munro Partners?
Munro Partners is set up to be your global growth equity manager. Global equities, growth.
And what has the journey of growth looked like so far?
Yeah, the journey's been a long journey. Like I said, we started with just the 3 founders back in 2016 and less than $20 million under management. But that's grown dramatically over the last 8 years, mainly through good distribution from our partners at GSFM, good performance from the investment team, and obviously good markets around global growth.
And what are the products that we offer?
We offer 4 products, absolute return, long only, climate, and SMID.
What is the team's investment philosophy?
So look, we run on a fairly simple philosophy that companies that make more money every year, their share prices generally go up. So what we look for is companies who can grow earnings structurally over a long period of time, and then their share prices grow structurally over a long period of time.
And our investment process has 4 distinct steps. What are they?
Yeah, so if you're looking for companies whose earnings go up every year, don't bother looking at cyclical companies, look at structurally growing companies. We have shrunk our universe to just 1,000 companies that we think can structurally grow over a long period of time. Within that, you need to find the highest quality companies, and so we have 6 great qualities for a great growth company, but you can't buy them at any price. You've got to do the maths, so we do the bottom-up maths on top of that to prove that they can double within the next 5 years. And the last part of the process is simply having a process for eradicating the mistakes that you're inevitably going to make.
Can you explain what an area of interest is?
So within our structural growth universe, the companies need to be structurally growing, so they have to be taking share from something else. And so these areas of interest are areas of what we see as structural growth.
And what would you say is Munro's edge?
Our edge is our process enables us to really find that simple solution of finding the few winners. Equity markets are a game of very few winners and lots of losers. Your job is to find the few winners. Our process is only looking for the few winners, hence we've become quite good at doing it over a very, very long period of time.
And I think we've got a pretty fantastic investment team. Can you tell me about them?
Look, the investment team is driven by the partnership. We own and control 75% of our business. We give the equity to our staff while they work at Munro, and when they leave, they have to give it back to the next person. That allows us to attract and retain really good people who are all working towards one goal, which is the profit share of Munro. The profit share of Munro is aligned with the results that our clients achieve. And so the investment team across all our strategies works across all our strategies, working towards finding these few winners to ultimately give good returns to our clients to get good returns for our business. That is our edge, that is our team, and there's no reason why we can't continue to attract and retain really good people to work at Munro to help us do this even better in the future. Look, thanks very much for coming along. That's a quick short video of who we are and what we do and how we do it. And the reason why we created that video is because, quite frankly, I got a bit bored of doing it after 9 years, saying the same investment process, what we do. We are your global growth manager and how we do it. And the other reason why we did it is because today we really wanted to cut to the chase. It is a very exciting time in equity markets, and it's a very exciting time to be talking about the 4 products that we want to talk to you about today. And so really quickly, we have 4 products here available at Munro Partners. They all run under that exact process that we just ran through, and they all are growth equity products because our goal is to be your growth equity manager. The first is obviously the Munro Global Growth Fund. A lot of people have that product. It was our first product. It's our absolute return product. That product is going for, what we're showing you here is the return objective and the risk objective. That's going for double-digit returns through the cycle, but with a beta below the market, i.e. it's growth equities with downside protection. The second product is the Munro Concentrated Global Growth product. This is exactly the brother product or the sister product of the Munro Global Growth Fund. It's exactly the same long positions, just without the downside protection. So it's giving you a little bit more volatility, but also a little bit more returns. And the last 2 products that Qiao and James are going to be talking about today is the Munro Small and Mid Cap Fund and the Munro Climate Change Leaders Fund. The Climate Change Leaders Fund is investing in the enablers of decarbonisation. It's very much a satellite product. And the Small and Mid Cap Fund is investing in small and mid caps. Both these products, slightly more risk, slightly more return. Now, all of these funds are run by exactly the same investment team, okay? And all of this investment team is based here in Melbourne. So I can assure you it's very nice to be back in our hometown, seeing our hometown audience. The entire investment team works across all 4 products, okay? They're all working together under the one process we just showed you to try and pick these few winners that we're looking for, these few winners that are ultimately driving the returns. The only thing I do is I just have final call as to what goes into our 2 all-cap products. Qiao has final call as to what goes into the SMID products, and James is working on the climate product. And so that's where we fit within the investment team. But it's important to point out that I'm contributing ideas to the SMID fund and Qiao's contributing ideas to the all-cap fund. We all work together as one team on one process. And ultimately, the good news about these products is, as we sit here today, they're all currently doing what it says on the tin. This is a line we use a lot at Munro Partners. Are we doing what it says on the tin? And as you can see on the left here, the absolute return fund is doing roughly 14% per annum with a beta of around 0.7, 0.8. So that's basically giving what we're looking for. Double-digit returns through the cycle, lower volatility than the market. On the right, you can see our long-only products. Our long-only products are all outperforming the indices and also have obviously had a very, very strong last 12 months. Importantly, you're all going to want to know, can we continue that strong performance? The one thing I would point you to here, that even though last year was a great return, our 3-year number's probably in line with our long-term average. And it sort of says you're probably only halfway through this cycle. We'll talk a bit about that today. Last thing I just wanted to quickly point out, the concentrated fund is slightly ahead of the absolute return fund at the moment, mainly because it runs a 100% unhedged currency book. whereas the absolute return fund is 50% heads back to Australian dollars. And so there has been a drag there from the falling Australian dollar in the absolute return product that we hope to get back over time if Australia ever becomes a dominant force in the world again. Okay, and then the last couple of final slides here before we jump into 2025. It's important to flag that we are active managers, okay? So you're paying active fees for our products. You're thankfully getting active returns. But this is how we think about active. So on the video, I talked about the areas of interest. Where is the areas of interest? Find the area of structural growth, find the winner. These move around, okay? So what I'm showing you here is the areas of interest in the Munro Global Growth Fund, so the all-cap products, at the start of January 2024. And then what it looks like today, January 2025. And so a year ago, for those of you who came along, you would remember we said we had a very big bet on AI. Okay, we thought AI was going to be huge. Digital enterprise, high performance computing were right up the top. Nearly 45% of our fund was positioned towards AI beneficiaries. And that basically is what played out. As we go into this year, you see we've moved the order around. High performance computing's gone down to the bottom. Climate, somewhat counterintuitively, is at the top. I promise I'll explain why today. But you've added things like security, companies that benefit from increased border security, increased public safety, and we've added things like infrastructure. So we've tried to broaden this portfolio out, and roughly the bet around AI is closer to 33% of the fund today. And so this is a broadening out of our portfolio as we broaden out into the market. Into the third year of a recovery. And look, the last slide I want to show you before we talk about 2025 is just simply to give you a report card on 2024. And so what I'm trying to do here is I'm trying to lift the hood to show you where the returns came from last year and show you basically how our process actually works. And so what you can see here is the fund did a 37.2% return last year. And on the left, I'm showing you the areas of interest that the attribution came from. High performance contributed 9%, climate contributed 7%, digital media contributed 4%. And on the right-hand side, I'm showing you our top 10 stocks, color-coded back to the areas of interest. And so what this is trying to show you very clearly, and this is obviously a good year, and this is what good looks like for us. It's just trying to show you the different areas of interest have all contributed to performance. It's not just one area that actually created all the returns. And not only that, the different areas of interest contributed performance, but ultimately we found the right area of structural growth, and we found the winner. So we knew high performance was going to be big, and we invested in NVIDIA. We didn't invest in Intel, thankfully. We knew climate had a role to play in how AI was going to be built, but we didn't invest in solar and wind, we invested in nuclear, like Constellation. So we found the area of structural growth, we found the winner. And finally, if you go further down, digital media and content, we knew sports rights were going to be big. We talked about this last year, we found Formula One. And as you can see, other ideas like Rheinmetall is in German defense, etc. So all of these areas is like find a different idiosyncratic area of structural growth and then find the winner. That is how our process works. That's what we're trying to do all day, every day, over the road in 80 Collins Street. The other reason why I wanted to show you this slide is because we're about to go talk about 2025, okay? So that's what happened last year. Let's talk about the future. And everybody in this room is going to want to ask me about Donald Trump. They're going to want to ask me about interest rates. They're going to want to ask me about inflation. They're going to want to ask me about Russia and Ukraine. They're going to want to ask me about all these things. And all those things are, yes, important, but this is actually how you make your money. Find your area of structural growth, find the winner. If you think you can do this repeatedly, then we can do similar results in the future as we've done in the past. Okay, let's talk about the market. I promised I would cover it. So I'm just going to give you a couple of broad views as to where we think we are in the equity market and why we think it's still a good time to be taking risk. And so from our point of view, we think you're moving into the third year of a bull market. A bit hard to see on that slide, apologies, but this is basically the S&P 500 over my entire investment career. And what you can see is there's three big bear markets in this market, all that I've lived through. There was a bear market in 2000, 2003, bear market 2007, 2008, and there was a big bear market in 2022, okay? It mightn't have felt like it here, but it was for us. The NASDAQ fell 33% that year. Your medium stock fell roughly 50%. Most growth managers fell that year, including us. It was a big clean out of markets. And that clean out happened because interest rates went from 0 to 5%. But that's done now. Interest rates have now peaked at 5%, and from here they'll either be flat or down. It doesn't really matter. And what you've seen now is a recovery in the market because earnings are recovering. And the market has just effectively gone back to following its earnings. What you'll also see if you go back to the previous bear markets is bull markets last longer than bear markets. Bear markets are 1 to 2 years tops. Bull markets are 3 to 5 years, sometimes 10. We're only going into year 3. It's too early for the excesses to have been built up. And so from our point of view, it should be another year of positive returns. Clearly not as good as last year. The best returns always go to the brave or to the ones who actually held on the whole way through. Thank you very much. But you should still get a good solid year of double-digit returns ahead of you. And the reason why we think that's the case is because earnings growth continues. This just shows you 4 big companies in the US and shows you their earning growth over time. And you can see it's ultimately accelerating. The US is very different to the Australian market, and I do talk about this all the time. But the equity market in the US is not really the economy, okay? The equity market has been driven by these big companies that have these huge structural changes behind it, whether that's NVIDIA in high-performance computing, Eli Lilly in GLP-1s, or Amazon in e-commerce. And if anything, this year that's actually going to get better because the economy is going to slowly recover as well. The earnings growth will actually broaden out this year. Current forecasts have S&P EPS estimates up 16% this year. If the multiple stays the same, the market's going to go up 16%. And so from our point of view, that's a reasonably positive backdrop. Not as good as last year, but still good. I promised a slide on Donald Trump. Okay. Big picture, the best way to think about Donald Trump is that he's basically a net positive for corporate earnings. And the simple anecdote we're using to say he's net positive in corporate earnings is if you look on the right, there are currently 11 billionaires in the Trump cabinet. He has put 11 billionaires for a total net worth of $400 billion, okay? These people are not doing it for the money. They're doing it out of their civil service. I personally would love at least 1 billionaire in the Victorian cabinet at the moment. That would be very helpful. They're clearly going to be very commercially minded, much more commercially minded than their Biden peers. Whether you agree with that or not politically, that's up to you. I just need to tell you what's going to happen to corporate earnings. These guys are going to be more net positive. What they're going to do is explore things like US tax cuts. They're going to do a lot more trade war onshoring. They'll probably allow a few more mergers and acquisitions. But the big one that we're most interested in is regulatory rollback. They basically want to get stuff built in the US and they want to get it built very quickly. And this is coming through consistently in all the speeches that they're doing. And this is ultimately a net positive. And it's sort of why our climate area is number 1. And I'll talk about that in a second. What these guys are going for, and it's probably just worth just having a quick think about this from a glass half full point of view. This is just showing you productivity per US worker over the last, 50 years? A bit less. And basically you can see what these guys are thinking is they're thinking like it's the 80s. They're basically thinking that they want to be a small government administration, very much like the Reagan administration. And they want to let the private sector instill productivity. This is what Doge is, this is what all of these things they're doing are. The other thing that I'd just point to on that slide, that was also the time the internet came along. The internet pushed this further through the 90s. And so from our point of view, you could potentially be in the foothills of quite a big productivity boom here. And I think you need to take a glass half full approach because if anything that the Trump administration does starts to work, i.e. lowers long-term interest rates, lowers the budget deficit, this will become a global phenomenon. Other countries will start doing it. Germany will do it. You'll see it happen in other parts of Europe, and you never know, it might happen one day here in Victoria as well. And so from that point of view, you have to think about this from a glass half full point of view. We're much closer to the start of this than the end. Last thing I'll just quickly say on valuation. Yes, the market is a little bit expensive. It's a bull market. This is what happens. It gets ahead of itself and pulls back. It's pulling back at the moment. But ultimately, those are all buying opportunities. The reality is the reason why the market's expensive is mainly because of the Mag 7 and mainly because of Tesla. If you do the equal weighted PE multiple of the United States, it's 18 times earnings, okay? So that's not really out of bounds. And Europe's sort of 14 times earnings. So from that point of view, this isn't out of bounds. Stocks have the room to follow earnings from here. Rates stay flat. The administration's roughly positive. I don't think you need to overcomplicate the macro outlook this year. It should be broadly positive, albeit clearly more volatile in a Trump administration and in the third year of a bull market. Okay, so how have we positioned the fund for that outlook? Okay, so what I'm going to be talking about here is exactly what I just showed you before. This is going to show you the positioning of the Munro Global Growth Fund and the Munro Concentrated Growth Fund, or its long-only equivalent. To be clear, they own exactly the same long stocks. So I'm not quite sure why we called it the Concentrated Global Growth Fund, but one day I'll be able to fix that. They own exactly the same long stocks. And so from that point of view, we're basically showing you back to this slide. These are the areas where we see strong structural growth. What I was talking about before, these are the areas where we see strong structural tailwinds that will ultimately, hopefully, equal the winners that we're going to find in 2025 and beyond. The top area as we go in is climate, okay? So why is climate number one in a Trump administration? The reason why climate is number one in a Trump administration is because most of the companies in this climate area are companies leveraged to power, leveraged to electricity growth. We're talking about nuclear power, we're talking about grid investment companies, we are talking about HVAC and air conditioning companies. All of these companies are leveraged to the power shortage that's going on in the United States, and also very leveraged to the hyperscalers who are clearly spending all this money on data centers. Below that, we have digital enterprise, which is cloud computing, digital media and content. I talked about security earlier. These are companies that benefit from public safety spending, infrastructure, innovative health, and down the bottom is high performance computing. And so in the next part of this presentation, what I'm going to be doing is I'm just going to go through the AI parts of this. So a year ago, it was very heavy AI. It's slightly less AI this year, but we still very much like artificial intelligence, and I'll talk about that in my next section. James is then going to come up and talk about the climate section a bit, and also refer that in returns to the climate fund. And then Qiao's going to get up and talk about the SMID-cap fund and touch on these areas like security and infrastructure. And as you hear us go through the James's and Qiao's presentation, think about some of those ideas being layered in here into the all-cap funds as well. Okay, but let's quickly talk about AI. Okay, so this is what we got right the last 2 years. This is a slide I showed you last year, and I actually showed it to you the year before, okay? This is how we thought about AI, and this is how we've been making money out of it, and this is how I think we'll keep making money out of it. So what we said a year ago is at the top, AI is a bit like your iPhone. You're having your iPhone moment. Do you remember I said last year, we talked about the first time you saw Shazam? Do you remember Shazam, the first time you recorded a song and listened to it? You basically thought the iPhone was the coolest thing in the world, okay? AI is the same. You're all seeing these great applications that are all appearing at the top, and they're appearing across all these different industries. All of them need to be run by the cloud service providers, and all the cloud service providers have to spend, quite frankly, billions of dollars on NVIDIA chips and the NVIDIA supply chain, okay? And so 2 years ago, we said very clearly, you want to buy the shovels in the boom. We don't know what the cool applications are going to be, so why not just buy the shovels, buy the weapons manufacturers in the war, so to speak. As we move into year 3 of AI, so not only are you in year 3 of the bull market, you're in year 3 of AI, we're going to be moving to the top. We're going to start panning for gold. We're going to start looking for applications. We are already looking for applications because this is where the big asymmetric upside is, and you'll definitely hear Qiao talk a lot about this when she talks about some of the small caps that we found. Before I talk about the applications, let me just quickly cover off the shovels because obviously this has been a bit controversial. Here we're talking about high performance computing and connectivity. This is obviously what's controversial with DeepSeek, etc. I wanted to just quickly cover this off. So when the DeepSeek story broke, again, that's not a surprise. These stocks have done very well. People are always looking for a bear case. But I want to be really clear, the cost of AI models has to go down over time. If they don't go over time, we're not going to use this stuff, okay? This is perfectly normal in technology. What I've shown you here is semiconductor demand for the last 60 years, okay? So 60 years ago, we could only build an IBM mainframe because semiconductors used to cost $10,000 each. That is, those same chips today cost 50 cents. Yet the market's now at $600 billion. So as the price goes down, we can do more things with technology. And as the price of semis went down, we went through the PC era. As the price went down, we went through the mobile era. And as the price went down, we created the cloud, and that eventually created AI, and now we're in the AI era. So AI models have to get cheaper, okay? They have to. It doesn't for 1 second mean anyone's going to spend any less money. It just doesn't. Happy to take that up in the Q&A. What we're actually seeing is these models and these clusters getting bigger and bigger and bigger. So every new model that's built is built on a bigger cluster of NVIDIA GPUs. This started with ChatGPT-3 with 10,000 GPUs. ChatGPT-4 is 25,000 GPUs. Grok 3, which is the XAI model, which was released 2 weeks ago, was built on 100,000 GPUs. They've already said they're going to go to 200,000 GPUs. Facebook wants to build a 400,000 GPU site. And Donald Trump wants to build a $500 billion data center, okay? So this doesn't look like it's slowing down to us. If anything, it looks like it's speeding up as these bigger and bigger clusters get built to build bigger and bigger models. And this has actually been 100% confirmed already by the CapEx forecasts from the hyperscalers, okay? So on the left here, what I'm showing you is the CapEx forecast for the big four hyperscalers being Google, Microsoft, Amazon, and Meta. And basically, 2 weeks ago, we thought they'd spend roughly $250 billion in 2025, sorry, $280 billion in 2025, up from $250 billion last year. So we thought that would grow about 15%. They've since announced that they're going to spend $350 billion this year. And so it's actually going to go up 43% from last year, okay? So hyperscaler CapEx is going up 43% this year. And so what we do at Munro is basically say, well, if something's lifting CapEx by 43%, where's that money going to go? Follow the money, you'll find the earnings growth. Find the earnings growth, you'll find the winner. All of that money, the large chunk of that money, is going to go to NVIDIA, and the rest of it's going to go to their power suppliers. And that's essentially how we've positioned here. And so from our point of view, NVIDIA just reported results last night. Thankfully, it's okay. Otherwise, this could have been a tough speech. But from our point of view, NVIDIA is still a buy. We are not leaving our wingman. NVIDIA today, you can buy it at the same multiple today that we bought it back in 2018, 31 times earnings. All it's doing, as you see at the top there, is just following its earnings higher. Right now, it's going to do $4, roughly $5 in EPS this year. We think it does $10 by the end of the decade. If the earnings double and it stays at the same multiple, there's still room for the stock to double from here. Clearly, it's not going to go up 20 times like it has for us. So we clearly reduce this position size versus what it otherwise could have been, but we still really like NVIDIA from here. If you're too scared to buy NVIDIA, you can still just buy TSMC at 22 times earnings. They make all NVIDIA's chips. And so from our point of view, you know, these things are not out of bounds valuation-wise. They've got strong earnings growth. They're clearly the winners, and so we just expect them to follow their earnings this year in what should be another good year for these stocks. But as I said earlier, the really exciting bit is the applications, okay? So the applications is where the fun's going to be had. We see this in things like digital media and content, and we see this in software companies. And so if you think about a year ago or 2 years ago, everyone was sitting here saying, you know, I like AI, but what's the killer app? Like, what's the killer app that's going to solve all of these problems? And I would just put it to you that the killer app is everywhere. You just need to look. So from our point of view, the big difference about AI and why we are still very bullish AI, I said it's part of a broader portfolio this year, it is, but we're still very bullish because ultimately AI is the one technology that affects the entire planet. Okay, so every other tech change we've been through has really just affected people like you and me. We're called knowledge workers, by the way, or at least purportedly knowledge workers. And so from that point of view, we're basically getting the benefit from our computer screen and how we use software, or from how we use our mobile to do our job every day, if that makes sense. That's how most technology shifts have happened from here. But AI is different. AI moves into the physical world, okay? It doesn't just make software better. It can actually solve robotics. It can actually solve autonomous driving. It can solve security and threat detection. It can solve MRIs and cancer discoveries. It can solve drug discovery. It can solve digital twins in different buildings, and it can solve all of these different things. And so the real TAM for AI is the dollars you save. It's the people's time that doesn't need to be spent on these difficult tasks. It's the increased customer satisfaction. And it's the cash savings. So the reality is that the TAM of AI, we see every company on the planet is going to lean into this technology. And they're going to lean into it to try and beat their competitor. We have some examples for you, I believe, with a bit of luck. Yeah, so a year ago I showed you this, okay? So this is what everyone was using AI for a year ago, right? They were basically saying, hey Nick, here's your webinar. I'll take your webinar and I'll post it into here. And the AI model will watch the video and turn it into text, okay? So that's what I showed you a year ago. Nick, watch this video. What did Nick say last year? I said NVIDIA was going to go up. It was right. I said it the year before as well. Hopefully I'm right this year as well. And it would summarize it for you, okay? So that's what we're all using AI for every day today. Okay, but these are some of the other things. These are non-playable characters, NPCs. My kids call me an NPC. It's not a great name. But the reality is you can now use an AI model to create what the non-playable character is going to say, and it will program the mouth movements straight away because the model can understand the text and turn it into code. In the same way, the model can understand the video and turn it into text. Does that make sense? This is a digital twin of Ottawa. They've built it already, the entire city, perfectly digitally, underground and above ground. Think about how easily that's going to make people do new construction, to fit new construction into the other things that they're looking at, and to ultimately build a more efficient and easier city and build it quicker. That's a great cost saving, if that makes sense. Okay, this is drug discovery. Not as exciting as video, so I'll skip that one. This is robotics, okay? So think about this. If you can turn video into text, then you can turn video into code. So you can code a robot quite simply from a video. If you just do the video, you can now code how the robot moves its arms, okay? So you're accelerating the speed at which you can get to robot technology. And the big one that's out there that we all know is full self-driving, okay? Lots of us have already been in a full self-driving car. Like, it works, it exists. I've done it multiple times now, okay? This is a huge disruptive force. 30% of this city is car parks, okay? Arguably, sometime in the next 10 years, you're not going to need any of them. And so these are the TAMs that AI is disrupting. And so it's just getting bigger and bigger and bigger. The killer apps are everywhere. I have one last one for you. Just when we talk about Facebook, I've got a physical one. Okay, does everyone know what these are? Has everyone seen these? These are the new Meta glasses, okay? They actually invented these more than 2 years ago, okay? They're Ray-Bans, they're a Meta glass, okay? And so if I go like this, it's basically got a light on with a bit of luck, hopefully, and it's recording what I'm seeing in the room. Okay, that's what it's been able to do for 2 years, but I can now ask it, I can say, hey Meta, what am I looking at? And Net is now driving back into my ear. He says, you're looking at a room of people who are looking back at you. That's super exciting, but it's taken the picture and turned it into text, okay? So extend that a bit further. I could look at a sign in a foreign language and it will translate it for me. I can look at a collection of ingredients and it'll turn it into a meal for me. And the best thing, which I can't wait for them to do and they don't do yet, I can wear these at the school cocktail party and remember everybody's name. And so the best thing about this, Facebook's actually made these. 60% of all Ray-Bans are now smart glasses, by the way. And as you can see here, we're still only paying 22 times earnings for it. So the big opportunity here, I talked about the shovels, we still like them, but the big opportunity here is try and find the company that has the killer application, because you don't even have to pay for it. You're paying 22 times earnings. There's nothing in the price for this, nothing at all. And it could be a huge product, it could not be, it doesn't really matter, it's a free option. Qiao's going to talk a lot about these today. Okay, last thing just quickly for me to cover is climate. Why is climate at the top? Because every time I ask those Meta glasses a question, every time a non-playable character does the voices, every time a robot tries to learn off a video, every time a full self-driving car talks, it's doing what's called an inference query. It's doing an inference query, and an inference query uses 10 times as much electricity as a search query, okay? It's just more compute, it's more expensive. That's why this arms race is going on. What does that mean? Is you get massive data center capacity build out. What does that mean? You're probably going to inflect power demand in the US positively for the first time in 20 years. And so what we're trying to invest in here is the companies that are going to help build out this grid. We're basically taking that $350 billion and saying some of it's going to NVIDIA, but a lot of it's going to go to these companies. And that's why climate is the biggest. The last bit, as I pointed out before with the Trump deregulation, this is what Trump is going to focus on. He is going to focus on getting this power built because they want to win the AI race. Donald Trump has already announced there's an energy emergency in the United States. And he's not talking about oil, okay? He's talking about electricity. So this is why this is the bigger bet this year rather than semiconductors as was last year. The company we like here that's done very well for us is obviously Constellation. I talked about it last year. It's the world's largest installed fleet of nuclear power plants in the United States. Sorry, the US's largest installed fleet of nuclear power plants. And so from that point of view, these nuclear power plants have gone from sort of orphan assets to now strategic assets. And the reason why is because A, they have the largest source of carbon-free power, but B, the companies that are spending all this money, the $350 billion, also have the strictest net zero targets in the world. And so they're not going to build these data centers with coal-fired power units. They're going to build it with either gas that they carbon capture or nuclear. And we've already seen this already because Microsoft reopened Constellation's 3 Mile Island nuclear plant, paid them $20 billion for a 30-year contract, and paid roughly 100% premium to the power price for the next 20 years. And they did that because they need this power. So what we're doing here is just following the money. That's how we're thinking about AI. So just to summarize really quickly, from our point of view, AI is still an area we want to be in, but we're going to do it in a broader portfolio this year. It was a very big bet last year. We had very good returns out of it. We definitely wanted to bank some of those returns. But most importantly, we're going to evolve this towards the applications and evolve it toward power. And we still think you're only 2 years into something that's going to go for at least 5 to 10 years. And so from our point of view, a very exciting source of opportunity for us. What I'm going to do now is let James come up and talk about the Munro Climate Leaders Fund. This was the best performing fund in the country last year, somewhat counterintuitively when Donald Trump got elected, but shows the value of active management. After James talks, Qiao's going to talk, and as they're talking, I want you to think about what it's like being me. Because I have these great fund managers doing these great funds that are performing better than mine, quite frankly, and I have to ultimately pick the best ideas out of them to run those all-cap strategies. So I'll let James jump up and then Qiao, and then I'll come back at the end. Thanks very much.
Hi everyone, thanks very much for coming along today. Thanks team at GSFM for putting on this event. So as Nick mentioned, I'm going to talk about the Climate Change Leaders Fund. That's an unlisted fund and also available via the ETF on the ASX MCCL. So like Nick, I'll just start with a report card on 2024. We had a good year. Fund was up 65%, so I'll just sort of show how we did that. So what we're showing here on the left-hand side of the slide is the areas of interest that we invest in within climate and their attribution for the year. And then on the right, I'll tell you about some of the stocks as well that generated that performance. So you can see the biggest contributor was energy efficiency. So that's companies that help decarbonise buildings like this one, be it lighting companies, electrical companies, HVAC companies, heating, ventilation, air conditioning companies, insulation companies, etc. So they were the biggest contributors to performance last year. Second biggest contributor was clean energy. So that's anything with low emissions, power generation, grid, etc. Third contributor was circular economy. So that's everything in recycling effectively. Big area of focus, obviously, sustainability. And then last area there at the bottom, very negligible performance because we didn't really have any exposure there, is clean transport. We don't like that area, so hence very little exposure there. On the right-hand side, other stocks that generated the performance, and as Nick was saying, you find the area of structural growth, and then you find the stock that can or the company that can leverage that growth. So within the purple colours, they're the energy efficiency companies. So we do hold NVIDIA in this fund because we do consider its semiconductors to be 20x more efficient than the incumbent semiconductors. So really important for decarbonising the data centres. So that's why this stock fits in this fund. The other companies in purple are probably more traditional HVAC companies like Comfort Systems, Schneider Electric, and Vertiv as well. In the burgundy colour, the clean energy companies, as Nick said, we don't own much in the way of solar and wind. We've actually decided to go more the way of nuclear and other areas and the grid. So Constellation Energy, Nick just talked about, the big nuclear energy company. At the top, Vistra is similar, also a nuclear power generator. And then we have GE, Vernova and Quanta as well, more on the electrical grid side of things. Last stock there that we've made a lot of money out of, or made good money out of, is Clean Harbours, which is a recycling business. So yeah, we had a good year last year. So obviously the question is like, where to now? What does this year and coming years look like? So we just sort of encourage people to take a big step back and look at the problem that's obviously trying to be solved here, and that's obviously emissions. So emissions curve hasn't bent at all, hasn't started to come down. Still building more coal and still burning coal today. So obviously a big problem for the world to basically address, and it's going to take a long time to do it, and it's going to cost a lot of money. So optimistically, 2050 net zero target's going to be very, very tough to hit, but we at least have another 25 years ahead of us of this sort of spending that needs to occur. So yeah, long opportunity ahead of us basically, a big opportunity ahead of us. We showed this slide last year and actually the year before as well. So what does decarbonisation look like? How does it happen? What's the opportunity? So we talked about a $50 trillion spend to decarbonise the planet. The way I'd encourage people to try to think about that is flip it on its head. Think about the $50 trillion opportunity for the companies that are going to enable this decarbonisation. So the companies that are going to sell these products that basically allow for this energy transition. We think that's a $50 trillion revenue opportunity for those companies. Within that, how does that sort of break down? So we think it's about a quarter energy efficiency. So it's decarbonising buildings like this one, because frankly, buildings like this one are responsible for about 25% of global emissions. So it's about 25% of the spend. Beyond that, you've obviously got renewables, 18%, passenger EV, 18%, transmission grid, batteries, hydrogen, et cetera, et cetera. So that's sort of how to think about the opportunity at a very high level and where the money's going to be spent. So that helps us sort of frame up where we want to look for the companies. Okay, so obviously a very large opportunity, $50 trillion, going to touch all these different sectors and industries, but doesn't necessarily mean you want to be invested in all of those industries today and all of those companies today, because some are just too far off into the future or they're too difficult to invest in because they're too competitive. That's why we've had the majority of our portfolio in the clean energy side and the energy efficiency side. That remains the case today. Circular economy is a really nice place to invest, obviously because there's a lot of sustainability investing going on, a lot of focus on reuse and recycling. And then we don't want to be in clean transport because of that competition issue, particularly from China. I'll talk about that in a moment. Okay, so why is clean energy the biggest piece of the fund still today? It's basically because of this slide here. So 20 years of bear market in electricity generation demand requirements because the US has basically been outsourcing to China effectively. So globalisation means industries left the US, so you've had no growth in the electrical grid. Now all of a sudden that's going to change. It's going to change because there's some pretty big structural tailwinds occurring. So we talked about data centres. Nick showed the CapEx slide. Data centres are about 3% of power load demand today, going to probably 10% by the end of the decade if you look at that chart that Nick showed with all the CapEx going in. Electrification, obviously electrifying transport and electrifying buildings like this one. So think about taking out an old oil or gas boiler for heating and replacing that with a heat pump. It needs to connect to electricity to the grid. Think about replacing your 2 petrol cars in your driveway with 2 EVs. You're going to double the electricity consumption of your household by doing that. Then obviously the last one's reshoring. Nick touched on this with Trump 2.0. Obviously this has been going on for a while now, but this administration wants to bring more and more manufacturing back to the US, and a lot of that manufacturing is highly power consumptive when you think about semiconductor fabs, healthcare manufacturing, etc., drug manufacturing, etc. So all of a sudden, after 20 years of basically flat demand, you're going to see a pickup in demand. It's probably going to be a low single digit, couple of percent. Doesn't sound like a lot, but it's a lot when you consider the magnitude of the jump, and it's a lot when you consider that the grid is basically 20 years past its use-by date, in terms of a lot of it hasn't been invested in for a long period of time. So that's going to necessitate a response. So the response is going to need to come from a variety of areas. So first of all, you need to make the assets that are requiring power more efficient. So that's improving efficiency of the buildings, so HVAC again. You need to fortify the grid as well. You need nuclear. Nuclear is going to be very, very important, and we'll talk about that in a second. And then obviously need renewables and storage. So renewables and storage are still an interesting place to look at because you're going to need a lot of growth there, albeit it's pretty hard for the companies at the moment to make money. Okay, so why nuclear? We'll just sort of drill down on this. And this is a slide that we've been using for a while. On the left-hand side, just to sort of illustrate why we looked at nuclear in the first place 3 years ago, and why we thought existing nuclear would become increasingly important in the US. Basically what we're showing here is across the x-axis, you're seeing nuclear, obviously very high capacity factor and very low emission. So we knew that profile would become increasingly important for industrial companies or industrial customers, including the hyperscalers, as they went to net zero. So we knew they'd pay a premium for that power. At the same time, you're obviously shutting coal and gas, or attempting to shut coal and gas, and replace it with wind and solar, which is increasingly intermittent. So we knew that that power from nuclear would become increasingly scarce and increasingly valuable. Obviously, governments are now recognising this and have pivoted back towards nuclear. So on the right-hand side, what we're showing is the countries that have signed up to triple their nuclear capacity by 2050. It's going to be very, very difficult for them to do, but you can see that the countries are starting to pivot back this way. So I'd even point out Japan on that list, given Fukushima. They've now come back to nuclear as well. Even the new German Chancellor's talked about stopping the decommissioning of the plants as well in the last week or two. So a big pivot back from governments to nuclear, which just basically reinforces our thesis around the importance of that for a power generation source. Okay, so we get a lot of questions on Tesla, obviously, and EVs, and we haven't been invested there for quite some time. And the reason is basically because of the competition, particularly from the Chinese OEMs. So China has these new electric vehicle or energy vehicle programs that obviously support the development of that industry in China. And it's obviously led to a lot of competition because there's basically a glut or a short-term glut of EVs as you've had all of these new car makers come into the market. So basically that's meant that prices have had to come down, margins have come down, and therefore profit estimates have come down for Tesla and others in the market. So that's why we've been steering clear of that area, and we remain out of that area today. Okay, yeah, a lot of questions on Trump 2.0 as well and what that means for the climate fund. We had a lot of questions from Simone and Zane's clients around Trump pulling the US out of Paris and what that meant. We thought that the bigger risk would actually be around the repeal of the IRA, the Inflation Reduction Act, which was Biden's signature green piece of legislation, basically tax credits for each of these areas on the left-hand side. Coming out of 2023 and into 2024, we obviously knew it was an election year and there was a potential for Trump to come back. So what we decided to do was basically move the fund away from wind and solar and electric vehicles, which would be less popular with Republicans, and into the areas where there'd be bipartisan support. So again, nuclear, clean hydrogen, carbon capture and building efficiency. And so we basically positioned the fund for that back from the end of 2023, and we remain positioned that way today. The good news is on the right-hand side, what we're showing here is basically the fund by valuation band. And a lot of these companies are basically hiding in plain sight. So nuclear companies, building efficiency companies, etc. I talked about that 25-year at least tailwind for growth, where they're probably going to grow their earnings in the double digits for that period of time. You can still buy those stocks, the majority of those stocks, for between 10 and 20 times EV/EBITDA, which isn't particularly expensive in our view. So yeah, it's still pretty decent sort of backdrop for the companies and the stocks we think. With that was my last slide. So I'm going to hand over to Qiao. Let's talk about the SMID fund. Thank you.
Thanks, James. Hello, everybody. My name is Qiao Ma. I'm a portfolio manager at Munro Partners, and I take care of our SMID fund, otherwise known as the most fun job on the investment team in Munro Partners. We just finished our first calendar year for the fund. It was launched roughly 16 months ago. We had a really good year. We were up 58% for the year, more than double of what our benchmark did. And what really makes us proud is, back to Nick's point, at finding the right structural areas of growth and finding the winners. We basically just follow that process. We find the right structural growth areas, which are these 5 to 6 different areas of interest. And we find the right winners just on the smaller side. We end up finding 10 stocks that contributed significantly to the overall fund performance, and I look forward to telling you more about them. But before then, maybe let's talk a little bit about how we organize ourselves. We set up the fund a little bit different from day one at Munro Partners. We wanted the entire investment team of 12 people to get involved with the SMID Cap fund. So I sit in the incredibly luxurious position of running a SMID fund, yet having all 12 people running it alongside of me. The outcome of that is we take all the learnings and expertise of studying these areas of interest, studying these structural tailwinds, studying these really massive winners in the world for over a decade across the entire investment team, and we just take it down the market cap. What do I mean by that? Well, let's take high performance compute. We take 10 years of learning about covering NVIDIA at TSMC. We know exactly for a semiconductor company at this point of the cycle what your success should look like, what your customer mix, what your profitability, what your cash flow conversion should look like. And we just take that criteria, go down the market cap, and that's how we find the small and mid cap winners within the same high performance computing areas of interest. So in other ways, we really know what success looks like, and we know what we're looking for. And the second really big advantage of organizing ourselves this way is we know who to call. It turns out that the companies in the top half of the page, which are existing portfolio holdings for Munro Global Growth Fund, are some of the best channel checks for the management team for the small and mid-cap fund. We know who to call to check out the management background, its track record, how good the performance and the products really are. So when you put the two together, we know what success looks like, we know what we're looking for, we know who to call. That really translates into a higher hit rate when we pick these small and mid-cap stocks. Why were we so excited about the small and mid-cap fund at this point still? Well, let's take a step back again. when we started the fund, and some of you might have come to this lunch last year, I said, well, guys, the valuation backdrop is really appealing. This is the largest gap we've seen between the small mid-cap companies and their larger cap peers in 20 years. Not since the dot-com bubble did we see the smaller end of the market cap get this cheap. Well, we've made 58% in 1 year. Amazingly, that gap has not even started to close. We think that's ahead of us, especially when interest rates starts to fall. But the second reason why we're excited, and probably even more important than just the valuation backdrop, is we see earnings growth reaccelerating again within our areas of interest. These are 4 stocks. They're actual stocks that we currently hold in the portfolio in 4 different areas of interest. Some of these stocks, their earnings might have taken a bit of a beat between 2022 and 2023, but they're squarely back on that reacceleration path in 2024. And that is all because of the structural tailwind behind their back. They have not received any help from interest rate falling, from the broader economic recovery, from, God forbid, M&A coming back to the space, to any of the regulatory rollback, to any of the tax cuts. Even when some of these factors come into play in 2025, we actually have reasons to believe that earnings growth might further reaccelerate into 2025. So when you put the two together, really supportive valuation and reaccelerating earnings growth, that's pretty much the holy grail for a growth fund manager. This is why we started the small mid-cap fund to start with, and that is why we're still excited about it looking forward into 2025. Now that part is over. Let's get to the fun part of my talk. This is how the fund is positioned now. The top 3 areas of interest are security, infrastructure, and climate. And some of you might be surprised that none of this is even in tech. Now, as a shop, as a fund, we love tech. So this is not because we're purposely getting tech out of the portfolio. We really like it. But we keep finding these less discovered, less talked about, really secret little winners trading at incredibly attractive valuations at these different areas of interest. And that's why they keep becoming major holdings of the fund. So in the next 5 to 6 minutes, I'm going to give you a rapid fire. 4 areas of interest, 4 stock stories, and hopefully that give you a bit of a flavor of what we're holding. Let's start with security. We really like these areas of interest. The underlying driver for the growth for security in the world, unfortunately, is the escalating threat environment. This includes the geopolitical risk. This includes the domestic crime prevention. This includes the border control, and this goes all the way to the cyber attacks and the cyber thefts that we read on the newspaper every single day. So companies that provide solutions to these widespread global problems really have a multi-decade growth trajectory ahead of them. We like these areas of interest so much, we end up picking 6 stocks out of the same areas of interest. And they really cover a very wide range of products. They go from a pure play military-grade drone company in AeroVironment that goes to a German ammunition company, Rheinmetall, that's really getting some nice tailwind now that NATO is increasing their military budgets, to the defense electronics winners in the United States and Canada in Curtiss-Wright and BWXT, and all the way to a state and local police enforcement technology company, Axon. So Axon Enterprise was started back in the 1990s by a founder who tragically lost 2 high school friends in a gun shooting. Ever since then, he started a company that sells tasers to the local police department, since tasers is obviously a less lethal weapon. So for 20 years, Axon went state to state, city to city, convincing the local police department to replace guns with tasers. The outcome of that endeavor is they are the only game in town. This is a monopoly of tasers for all the state and local police departments in the United States. Being an incredibly innovative company, Axon realized, well, tasers were great, but when the police use tasers, they still get sued a lot. So it came up with a body camera that the police officers start to wear on themselves when they go out patrolling. Whenever a taser is pulled and deployed, not only the body camera on that police officer turns on and start recording the event, but all the body cameras of all his buddies in the vicinity also turns on, start to record the event, and all the videos get seamlessly uploaded to the cloud, to the evidence management system that Axon runs. So this has been great, and this company keep growing at roughly 20% a year for basically its entire life cycle. Then 2023 happened, and generative AI happened. Axon realized, I already have this massive video footage sitting on the cloud. Why don't I plug a large language model through to the videos? And they come up with a software called Draft One, and it's exactly what it is. AI will watch the entire video patrol and write the first draft of the police report. The customer perception is off the charts. The police officers were so glad they no longer need to spend 2 hours in front of a computer writing reports on every shift. So the adoption goes through the roof, and Axon's profit and revenue and just followed. That 20% top line and bottom line growth that I just talked about accelerated to 30% revenue growth. And because software is so margin accretive, it really accelerated to 50% of profit growth. Axon just reported earnings about 24 hours ago, and they just gave a full year annual guide of 2025 that really supported that top line growth of 30 and bottom line continued to grow even faster than that. Unsurprisingly, its stock price simply followed the earnings. The next areas of interest is infrastructure. Now that caught a lot of investors by surprise. What is a small cap growth fund doing investing with infrastructure? We love infrastructure as an areas of interest. Now, I spent a good part of my adult life in the United States, love the country, but if you think about the United States as a house, that house is about 20 years behind maintenance schedule. The roofs is leaking, the pipes are rusty, it's not in a good condition. On top of that, reshoring, manufacturing activities are coming back. The pressure on the infrastructure is simply crazy. The support and the investment into infrastructure in the country really transcends the bipartisan policies. So we see really supportive stand from both the Republican and Democrats at investing in infrastructure. We picked an incredibly interesting company called Comfort Systems. It's a specialty contractor based in Houston, Texas. Now, I don't know if some of you have been to any of the southern states lately, but the south of the country is booming. Infrastructure, logistic, warehouses, massive battery factories, data centers are all getting built, concentrated on a few states with the availability of power. So what Comfort System does is for these really large industrial contracts, after you think about putting up the 4 walls of the project, Comfort System comes in and basically put in the wires and the pipes for all these very large projects. All you need to know is this is a very high quality contractor. For its entire life, it roughly grows 8 to 9% of both revenue and profit. Now it is sitting on the biggest backlog it has ever seen in its company history. It has the richest pipeline and the best visibility into that pipeline. It's already growing 20% of top line and 25% of profit. So twice as fast as what it's been historically growing. Yet you can still buy Comfort System at the exact same PE multiple it always trades at roughly 16 times. So this really encapsulates what we're seeing in infrastructure is you see clear reacceleration of earnings in some of these old school companies, yet you still have the opportunity of buying them at the exact same historical PE valuations, which is just incredibly attractive to the growth that is actually delivering. Talk about companies that's growing really fast and trading at a really low multiple. We can talk about SharkNinja. Now, SharkNinja is a consumer company that some of you might have the Shark branded vacuum or the Ninja branded blenders and multi-cookers sitting at your kitchen counter right now. If you don't, you should go home and check it, and most likely you already have one of their appliances in your home. At the core of it, SharkNinja is an innovation machine. What I really mean by that is a top-notch, very, very innovative consumer companies in the world roughly come up with 1 to 2 new products a year, and it takes them 6 to 12 months to come up with that product. SharkNinja consistently come up with 15 to 20 new products per year, and it takes them just 3 months for a product from design to hitting the shelves. The outcome of that is within small appliances and really anything that goes inside and outside of the home, category by category, SharkNinja just attack them and end up running away with the top market share. There's only one example that really drives home how aggressive and how successful it's been at capturing market share. It's after 6 years of launching in the UK, Shark is the #1 vacuum brand in the United Kingdom, overtaking Dyson in its own backdrop. That's really how impressive it's been at growing its market share. The outcome of that is for 20 years, SharkNinja continued to grow revenue at 20% and profit higher than that. And the great thing is, because this is still a small cap consumer company, you can buy this incredible innovation engine at 17 times earnings, even today. And finally, digital media and digital enterprise. Now I know, as a mother of multiple boys and a portfolio manager, I'm not supposed to have my favorites. But I can tell you, this is the area that we've found the first 3-bagger for the Smith Fund and the first 10-bagger for the fund 16 months into inception. And I think that the underlying reason of why these particular areas of interest have such an outsized movement is this is really the first area that AI lands, and AI lands hard. What I mean by that is Microsoft, we love Microsoft, but Microsoft is using AI. But this is a company with $200 billion of annual revenues. It takes a while before you start to see the hockey stick growth in the Microsoft revenue. Yet all these little companies, these logos on the page, they're small companies with a very small base of revenue and profit. So when AI lands, you have this massive reacceleration and a hockey stick in the revenue and profit growth, and this is really when you start to see the outsized return. More importantly, we think this is the first area that AI lands, and we fully expect to see this to continue into other areas of interest as well. The stock I will talk to you about is Reddit. So Reddit has actually been around for 20 years. But it's a new IPO. It came to the market roughly April last year, and it was incredibly misunderstood when it came to the market. People call Reddit a meme stock. People call it the Roaring Kitties platform. There's not a single serious fund manager in the whole world that is willing to be associated with Reddit. But we have been investors of Facebook and Google and Amazon for decades. When you actually look at the financials of Reddit, there is nothing Roaring Kitties about it. This is just a very classic internet platform going viral. First, it come the users. For 20 years, Reddit chugged along with roughly, quite 10-15% user growth. And now, because all the property sites, all these website information sites is just full of, property placement ads and product placement ads and AI content, Reddit is actually the largest platform for genuine human conversation. So the value of these Reddit's communities just becomes so much more valuable. And we start to see users growth now growing at 30-40% globally. And even in the largest market in the United States is growing 20-25%. So that's the first thing that caught our attention. Clearly, this platform is going viral. Secondly is advertiser. On average, Reddit still monetizes on a per user basis less than 1/6 of what Facebook is getting. Yet everybody that we talk to in the advertisers community talk about, I want to allocate more budget to Reddit. So that's the second sign that showed us this platform is going places. And lastly is international, and this is super cool. So it turns out Reddit's success had been historically mostly in the English-speaking countries because all the conversations were in English. Because of generative AI, Reddit is able to translate the entire corpus of content, that is 20 years of English-speaking discussions, into different languages with the cost of just $1 million. So it turns out when everybody in France can read what people in the UK and Australia and the United States are talking about, they start to have a really sort of ignited the local language discussions as well. So for the first time, Reddit is actually going viral internationally as well. So it just shows us a really, really cool example of how, one platform with AI, with the benefit of better technology, really start to have a hockey stick in earnings. And the good thing about Reddit is even after we have more than triple our money in Reddit, because the earnings growth has been so strong, that today you can still buy Reddit at roughly 35 times price to earnings for 70% growth. So I will stop it right there. I hope that gives you a flavor of what we own. If you back our small mid-cap fund, you are backing a specialty contractor based in Texas. You're backing a really viral internet platform. You're backing the best blender company in the world. And finally, you're backing probably the crown jewel of crime prevention domestically with tasers and body cameras and software. Thank you for your attention. I'll come back for Q&A.
Okay, so in the next couple of minutes here, I'm just going to wrap up what we talked about today, and then we've got about 15, 20 minutes for questions. So hopefully you've got a few lined up for us. Obviously, I started the presentation by talking about the 4 funds we have. These are the 4 funds that are available. Importantly, they all are available, all 3 of them, Munro Global Growth, Munro Concentrated Global Growth and Munro Climate Leaders, are available as managed ETFs on the Australian Stock Exchange. The SMID fund, unfortunately, is on platform and paper application, but is not probably going to be appearing as a managed ETF because it's ultimately capacity constrained. Those are the 4 products I talked about where they fit. Very quickly before I want to wrap up, I just want to talk about downside protection. It is important to flag the Munro Global Growth Fund is a downside protected product. We just gave you a very positive outlook. It was. But to be clear, I've been doing this long enough to realise that the things that catch you out are not the known unknowns, they're the Donald Rumsfeld unknown unknowns, okay? This just shows you the net exposure of the Munro Global Growth Fund over time. At the bottom of the short exposure and at the top is the gross exposure. And what you can see in this fund is we can lower the exposure very quickly. We did lower it in 2018. We obviously lowered it dramatically in COVID, and then we lowered it in 2022. We're doing that with a combination of things like put options, and we're doing that with cash, and we're doing that with short selling. At the moment, we do feel positive markets, so we are pretty much fully invested in the Munro Growth Fund. It's almost exactly the same invested as the concentrated fund. But important to flag, we are buying put options underneath it. Our view here is if we're positive, let's stay fully invested and let's put a safety net underneath it. We are spending a little bit, about roughly 100, 150 basis points per annum to put that safety net in, because most of the big risks we see out here, and I'll happily take them in the Q&A, are really left tail risks. They're left tail risks where Donald Trump's done something silly, Russia, Ukraine, the Middle East. They're mainly political. The macro risks are not that big right now. They're ultimately reasonably well known, and they could cause corrections, definitely. We're going to get corrections in a bull market. But the next bear market is probably going to come from the left field, and so this is the way we are protecting against it in the absolute return fund. And I just wanted to be clear about that because obviously we've given a reasonably positive message today. But beyond that, ultimately, I just want to go back to what I said at the start. Ultimately, how we make our money at Munro Partners is not to really get too hung up on that stuff. How we make our money is to find the area of structural change and find the winner. We talked about how we've changed some of these areas this year. We've moved more towards climate, more towards security, more towards infrastructure, and just de-emphasised at least the shovels in AI, and then moved more towards the applications in AI. That's pretty much what we talked about today. And that's just us evolving, being your active manager, evolving how the world is changing and how we think we can find the winners out of that, if that makes sense. Find the area of structural growth, find the winner. This is updated every month in our monthly and every quarter in our quarterlies. Please don't be afraid to keep track of it. That's how we did it for the Munro Global Growth and the long-only product. There's the long-only product. As I said, it's roughly exactly the same at this point in time with exactly the same companies. James talked about this with climate, where he's very much focusing on clean energy and nuclear, and energy efficiency, and less from clean transport. And then Qiao obviously showed how she's doing it in the SMID Cap Fund. The last thing I just wanted to flag was this, and so importantly, ultimately what we're trying to do here at Munro Partners is, and I talked about this last year, we're trying to improve our domain expertise, okay? So with these 2 funds, people often ask us about the overlap. We launched the Climate Fund 3 years ago because we thought decarbonisation was going to be a big thing. We also launched it because we thought decarbonisation would provide a good source of alternative alpha versus digitalisation. As a growth manager, you can get horribly big cap tech, if that makes sense, or you can horribly get all tech. This is clearly an area of non-tech being driven by something completely different than tech, and that's decarbonisation, and that's why we launched the fund, and that's ultimately worked for us. That's how we found Constellation Energy, that's how we found GE Vernova. 18 months ago, we launched the SMID fund, Qiao joined for exactly the same reasons. Let's try and increase our knowledge around small and mid caps. We're ultimately going to need these companies to help pick up the reins from big cap tech in the 3rd year of the bull market. And again, here we're looking for differentiated sources of alpha. And ultimately, these are feeding up to our all cap funds. Lastly, we can't hold more than 20% in one area of interest, so there will never be more than 20% overlap in the climate fund. And in the SMID fund, ultimately the ideas I'm picking out of the SMID fund to go into the all cap fund are the ones that complement the rest of the portfolio. And so you might have seen on Qiao's slide, AppLoving was their best performing stock, was the best performing stock in the SMID fund last year. Unfortunately, I did not own it in the all cap fund, and haven't I heard about that all year? But the reality is we owned Meta, which does a very similar thing. The ideas we took were Shark Ninja, because it's a consumer idea, or Rheinmetall, which is German defence, or Axon in our security area. Those are the ideas we actually did take into the all-cap fund, and they obviously help performance. This is ultimately, as I think, helping us get better at what we do. Okay, so we are getting better at this. We are getting better at finding the area of structural growth, and we are finding the winner. And this is coming through in our performance. You're also getting more differentiated returns, I think, versus some of our peers. And as I sit here today, under our partnership model, we continue to attract and retain really good people to come and work at Munro. You met a couple of them today. There's a heap more in this room today. They've all come to work at Munro, and they're helping us get better at this over time, and we hope to be able to continue to produce these good numbers for you into the future. And then finally, just before I go to Q&A, I just wanted to point you to our website, or on your page as a QR code. Everything we talk about today is on those videos. It's also, please join our mailing list. You get sent our podcasts, you get sent our annual letters. Don't be afraid to use that facility. And then before we go to Q&A, I just want to say thank you very much for everyone in this room for your support. And most importantly, thank you to all the Munro team members who are here for all your help in helping us produce these numbers for our clients.
Fantastic. So this will conclude the formal part of today's catch-up. We did promise to have you out of here right on 2 o'clock, which it is. A massive thank you to our Melbourne audience. A big thank you for your time today and obviously your ongoing support. A really big thank you to James, Qiao and Nick for your insightful presentation today. And it's fantastic to see that you remain really quite excited about the opportunities presenting themselves and are using this volatility to position the fund to generate meaningful returns for our investors in the months and years ahead. One team, one dream, 4 funds, all derived from the same investment process, all designed to fill a particular global equity growth bucket for you, your clients and investors alike. All 4 funds are highly regarded by asset consultants and research houses, recommended ratings with Lonsec and Zenith across all their major investment platforms, with 3 of the funds also available as active ETFs on the ASX. The team at Munro and the team at GSFM will be around for another 20 or 30 minutes, so if you do have time, we'd love to catch up and hear the latest from yourselves. If not, wishing everyone a fantastic 2025. We go around again, and we look forward to staying in touch and catching up less formally soon. Thank you.